We look at now the past examination trend. Now this topic has not been tested in the new syllabus so far, but again, this is an important topic, so we cannot again ignore it. You may expect a calculation based question, or it could be also a conceptual question. So we need to be very comfortable with this overall topic any which ways. Okay. Now, when you look at, again, as we talked about, of course, why a statement of cash flows is required. Okay, so we need to understand that you need to talk about the liquidity part of it, and how is the entity, for example, able to generate its cash, and where is it spending its money. So the standard actually talks about both aspects of the timing and amount of the cash flow. So it talks about the timing and amount of cash flow. So that's what you want to always remember when you look at this particular standard, right? So that's what it is basically. Ind AS 7 specifically has following objectives, right? Which says that the cash flow statements aims at providing the information about how much the cash has been generated, or for what purpose has it been utilized, right? So talk about, of course, the amount, right? And then the activities, whether we talk about the operating or investing or financing, right? So the OIF, that's the way we start looking at it. And this is a comparable information for the current year and of course also the previous year, right? Again, as we said, that the whole idea is whether the entity has an ability to generate the cash flows, and in what activities, what forms of cash flows it is able to generate. And finally, as we said, the timing and certainty with the respect of, let's say, the historical data, right? So you look at, of course, the statement to be prepared for the period and also the comparable period, to look at what is the timing and the amount of that cash flows. So that look at, of course, the amount here, the timing here, and of course, people would be able to analyze in terms of the certainty, in terms of how has been the history, how much the entity has been able to create, cash, let's say through operations, or how much cash it has been invested, in long-term assets, or whether the funding has been done, the financing has been done, and stuff like that. Okay. From the scopes perspective, any entity, be it a public limited or a private entity, you have to prepare, for example, the statement of cash flows, whether it's small or big. So it does not matter whether you are, a banking institution, or an insurance company, or a manufacturing company, or an IT company, or a service industry. You all need to prepare the statement of cash flows so that people can actually take a decision about your the timing and the amount of cash. That's something which is there, because you would want to kind of explain to them how are you able to kind of create that cash, and accordingly whether the cash is available for the financing activities like repayment of dividend, for the repayment of loans, for example, where the cash would be available for investment purposes and all that stuff. So that's where this statement of cash flows is required by all the entities there. Okay. Essentially, there are some terms that we need to understand, and that's what this particular section would like to explain to us about the key definitions, right? Cash, straightforward, any kind of a cash and demand deposits, right? Anything which is, let's say, in form of money which is as good as cash is going to be a part of course, your cash. The larger term is cash equivalents. Okay, so the cash equivalents are defined by the standard. These are short-term, highly liquid investments, readily convertible to known amount of cash and subject to insignificant risk of changes in value. And this is a bit more detailed explanation given in the definition itself. But importantly, what you're referring to is that something which is less than or equal to 3 months of maturity. Right? That's something which is identified. Something which is equivalent to less than 3 months of maturity, and wherein if you are converting them in cash, when you are liquidating that investment, right? There is a little change in the value. You don't lose a lot of money when you are making that change. Okay. And also this important term is there, that the amount of maturity, the amount at maturity is known to you already. Okay. So what you need to remember, it's a short term, anything which is up to 3 months of maturity from the date of origin, from the date of investment, right? Highly liquid, which simply means that it is as good as cash. If you change that into cash, nothing much changes. You don't lose money effectively, right? And then you're talking about known amount, which means that the amount that you're expecting to receive at maturity is also known to you, is something which is a cash equivalent. We'll see some examples, some small examples around it in terms of understanding whether something meets the definition of a cash or cash equivalent or not, right? Cash flows are simply the movements. It could be a positive cash, it could be a negative cash. So inflows and outflows would be there, of course, of the cash and cash equivalents. I think what you also want to remember, if we take you back to this particular definition, you want to remember that also that the statement of cash flows, right, the statement of cash flows does not require you to explain the movements, right? So there's no need to explain the movements, right? No need to explain the movements between cash and cash equivalents, right? Any movement between cash and cash equivalents. In a way, if I say I'm having, let's say, 10 crore rupees, right? Let's say it's lying in my bank account, right? And I put that money in a short-term investment. Okay. I'm putting that money in a short-term investment, which meets the definition of a cash equivalent. Okay. I don't have to report this plus or minus because it is as good as cash to me in both definitions. Okay. However, if this investment was rather made in a long-term deposit, right? Let's say for 2 years. Okay. Now that is where you start calling it that there's a movement. There's an investment made in some security, which does not meet the definition of a cash and cash equivalent. And that movement's reporting has to be done as a part of your investing activities, for example, right? So that's where you start analyzing that any movement between the cash and cash equivalent. And that's the reason why this definition is critical. It's important to know what actually is a part of the cash and the cash equivalents, because these are not reported. This would be a total balance, the opening balance or the closing balance of the cash and cash equivalents there. Okay. Operating activities will deal with those examples in detail. These are the principal revenue producing activities of the entity, which are not investing or financing activities. So it's a default category, right? Essentially, you can imagine if I'm a service company, so I know that I'm selling something, some services to my customers. If I'm a manufacturing company, I could be selling some goods. I could be buying some raw material. I could be paying for salaries, paying for rentals, etc. These are all my operations, right? For a company which is doing marketing or advertisements or any kind of overheads that's being incurred, they're all part of operations, right? So something which is which is involved in those things would be part of example of, let's say, an operating activity. Similarly, investing activity is all about acquiring or sale of long-term assets, right? Could be a machine, could be a plant, could be a goodwill, could be a patent, could be a license. You might be acquiring them, you might be selling them, you might be acquiring a stake in a company, for example. That's also an example of an investing activity. And finally, financing activities are purely in the change in the equity and borrowings, right? So if I really take you back to the broader perspective of, let's say, the balance sheet and statement of profit or loss, right? So I would say in my balance sheet, I have non-current assets, right? So any changes in that are a part of my investing activities. Okay. If I take you to the equity and non-current liabilities. Now, these are example of course, financing activities. If I'm issuing shares, if I'm buying back shares, if I'm issuing bonds, okay, if I'm taking a bank loan, if I'm repaying that, if I'm paying some interest on that, they're all a part of my financing activities, right? Everything else, which is in the balance sheet, I would have current assets or liabilities, right? My receivables movement, my inventories values, my payables, balances, and again, the entire P&L, which is my revenue, which is my expenses, they're all examples of operations. That's where I'm involved. This is where I do, as a part of my business, as a part of my principal revenue producing activities, right? So that's how you start connecting the dot between, or finding a relationship between a balance sheet, a statement of profit or loss, and a statement of cash flows there. Okay. So essentially what you want to really summarize here is that anything in the non-current assets, any movement in that, right, would be a part of my investing activities, right? Something you want to remember. Anything in the equity and non-current liabilities would be a part of my financing essentially. And then everything else, right, which is my current assets, current liabilities, revenue, expenses, tax in general, for example, they would all be examples of operating. All right. Now, importantly, what you also want to remember here is that if you talk about investing, then your interest income would normally be a part of investing only. You made a deposit, you received some interest on that. You invested in shares in a company for a long term, you received dividends for that, right? They would normally be an example of an investing activity only. Unlike, for example, if you're a bank. So for a bank, interest income is a part of the operations. So that would need to be remembered, of course. Similarly, if I'm borrowing money, then the interest payment, okay, or a dividend payment, they are both examples of financing. I funded money to my business, and repayment of those, or any payment relating to those fundings would again meet the definition of financing, right? So essentially the interest payments or dividend payments normally would be a part of my financing activities, right? And everything else from my sales perspective, from my royalties, from my expenses perspective, in terms of, let's say, rentals, or you talk about, of course, salary costs, you talk about administration charges, marketing costs, advertising, they're all going to be examples of operations, along with any changes in the receivables or payables. These are all operations or inventories, right? These are all examples of course, again, you talk about operations again, right? That's the way you start looking at it. Okay. Cash and cash equivalents, as we said, for example, the cash equivalent would be as good as cash, or investment which are as good as cash. Short term is specifically defined as 3 months or less. The objective is, of course, you would have probably an investment done because you have some idle cash. You don't want to just use it for a long-term purpose. Importantly, you want to also remember that both aspects of liquidity and the investment risk are to be matched here, right? Essentially, we are saying something which is having an insignificant amount of risk in the changes in value. Okay, that's something which is an important part of the definition. Okay, and of course, from a liquidity perspective, we're talking about short maturity of 3 months or less from the date of acquisition. The reporting date is not relevant. Essentially, if I say, how do we read it? if I say 31st of March 20 is my reporting date, right? And I've made an investment on, let's say, 1st of March 20, but this has a maturity date of, let's say, 25th of June. Okay. So I know between 31st of March and 25th of June, there are less than 3 months, right? This is less than 3 months, of course. But originally, this investment was made on 1st of March, where the maturity is more than 3 months of time, right? And if that is the case, we cannot, for example, that is the case, we cannot, for example, call it a cash and cash equivalent, which means that this investment of or maturity of more than 3 months of time has to be reported as a part of your investing activity. All right, it has to be reported. If it were a cash equivalent, so if I say on 1st of March I made an investment, but let's say with a maturity on 31st of May, right? Then it's a part of your cash and cash equivalent. We don't have to report that transaction anywhere. It becomes a part of your cash balance, right? We don't use the word cash balance, but we use the cash and cash equivalent from a presentation's perspective. Okay. Again, specifically, equity investments are excluded from cash equivalents unless they are in principle an example of a cash equivalent. Very, very limited scenarios you would come across. From an examination standpoint, you would normally be given that clarification in terms of whether such investments would necessarily meet the definition of a cash equivalent or not. Okay. Similarly, when you look at a bank borrowing, okay, you need to be again looking at it importantly. When it's a bank borrowing specific to a project, specific to a acquisition of an asset, specific in terms of the business, they are indeed a part of a long-term or a non-current liability, and they become a financing activity. However, when you look at a bank overdraft, right, you might have heard of a term called as a cash credit or an OD limit, right, an overdraft limit. They are a part of your cash and cash equivalents. Okay. Now, what does it mean? It simply means that I may have a cash and cash equivalent with the negative balance. Okay, you want to remember that. I may have a negative cash or cash equivalent in total because bank overdrafts are included as a part of that perspective. Okay, so essentially, when you look at the bank balances may become negative, and accordingly they may be reported as well in that context. Okay, essentially, when you look at the entire exercise, we are trying to kind of build in that clarification. We are trying to kind of showcase that very clearly to the users of the financial statements, that what is that cash or a cash equivalent that I have at any point in time. That is something which is a part of my cash management exercise. Okay, so I just need to be looking at it from that perspective, that I'm not over reporting something. I'm not just reporting everything, as a part of my operating or investing or financing activities. Something which is a normal cash to me, okay, is a part of my cash and cash equivalents, and I report it accordingly. Okay, let's have a look at few examples. It says that Hard Work Limited holds the following securities on 31st of March 19. You are required to find out which of the following securities will be a part of a cash and cash equivalent for the preparation of statement of cash flows under Ind AS 7. It says that the cash balance at various banks, for example, all branches of all banks in India, very clearly an example of cash and cash equivalent. Let's use the term CCE, for example, here, right? Next statement is all international branches. My cash and cash equivalents don't distinguish, be it a cash in an Indian bank, be it a cash outside India, be it a cash in a foreign currency, for example, be it a cash with any bank, they would all meet the definition of cash and cash equivalent very clearly. Okay, so we don't really differentiate between the kind of a cash. Okay, so you need to be very, very comfortable about that part, right? The fourth is a government bond. It says 6% open-ended bonds. The objective was to park the excess funds for a temporary period. Again, remember, you're talking about something which is a part of your cash management exercise, right? If it is not long term, it is going to be an example of cash and cash equivalents there. Okay. Next statement is 10%, 3 years maturity. It's not a cash and cash equivalent, right? It becomes a part of your investing activity and it is reported accordingly. Okay. Next one says 8% fixed deposit with Kotak Mahindra Bank. Original term was for 2 years, but is due for maturity in less than 3 months of time. You use that example. Again, not a part of CCE for a simple reason, because the original maturity is more than 3 months of time. Okay. Bank overdraft, the temporary overdraft payable on demand, is an example of cash and cash equivalent. Treasury bills with the 90 days maturity, they meet both the liquidity and the the risk perspective. The definition is met very comfortably. So even that is not going to be, that is also going to be an example of a cash and cash equivalent, right? So there are all the solutions. What all would be included as a part of cash and cash equivalent is highlighted here as well. Okay. Effectively, what we discuss is something that we are summarizing. The cash flow statements is basically how are you bringing money into the business and where are you putting it, right? How are the cash is generated and how is it being applied? And accordingly, you're simply looking at the reconciliation. Importantly, the reconciliation between the opening and closing balances, and the movements in those would be separated in three categories. One is operating. Go back there. One is operating, and second is investing, and third is, of course, financing. All right. Thank you very much.